Well, hey everybody, thanks for watching. This is Rob Satori, and today we're going to be talking mortgages, mostly seller concessions and buy downs. So what are seller concessions? Well, seller concessions or seller credits are credits from the seller to the buyer written into the contract to help buyers with closing costs, prepayments for homeowners insurance, and for the establishment of the buyer's escrow account. Seller concession can also be used to subsidize a lender fee, such as an interest rate buy down, becoming very popular right now. And they can generally range from 2 to 9% depending on the type and structuring of the mortgage being used by the buyer. Credit percentages are based on the purchase price and not the loan amount. Seller concessions have limitations based on the loan type and loan to value. So seller concessions can also result in the seller raising or reducing their purchase price. More on this at the end of the video, so stay tuned. So how do these work? Seller credits are generally agreed upon at the time of contract ratification. They can be used to assist with closing costs and discount points to buy down the interest rate, or a combination of the two. At closing, the amount of the seller concession is broken out on the closing disclosure so you can see how and where they're being applied to the transaction. For example, on an FHA loan, a seller can concede a credit up to 6% of the price to the buyer, and this can significantly reduce the amount of money a buyer is going to need to purchase a home, making it more affordable. Well, how do they apply to buyers or sellers in a real estate transaction? Seller concessions are more prevalent in a soft market like this. By soft market, I mean a market where buyers in the market are less and the demand for real estate has decreased. Using a broad definition of a seller credit, the buyer can use them in a couple of ways. Still, they're primarily leveraged to assist with closing costs, paying points to buy down the interest rate, or a 2-to-1 buy down, which we see increasingly in this higher interest rate environment. Sellers utilize concessions to buyers in order to incentivize the buyer to purchase the home by reducing the buyer's necessary cash to close. So how can buyers and sellers use concessions to their advantage? Concessions have limited application, but can be very helpful for both interested parties. If a buyer is short on funds to close, they can ask the seller to contribute a credit that will make up the delta between their personal liquidity and what's needed for closing. Although technically they must be applied towards the closing cost and not a down payment, sellers can concede funds to a buyer to induce or incentivize them to purchase a subject property. In a soft market like this, buyers have more of an ability to request that the seller concede funds to the buyer because there are fewer buyers in the market, thus making the buyer the center of the transaction. Suppose you're a seller and something small comes up in an inspection. It's not a deal breaker, okay? But in that case, you can offer a concession in the form of an addendum to cover the costs that the buyers, or minor repairs that the buyers would need to complete after closing to keep the transaction moving forward. That way you don't have to push the transaction back or wait for needed repairs to be completed. The most common use of a concession is to cover the closing costs or help pay points on behalf of the buyer. For buyers, a typical 2-1 buy down looks like this. Say you're a buyer that gets a loan with 7% interest rate on a 30-year fixed. That means that in the first year of your 2-1 buy down, your interest rate would be 5%, making your entry payment much lower. In year 2, the rate will go up 1%, making your second year payment 6%, right, allowing you to ease into your third year where you would be at the full of 7% for the remaining life of the loan. Just remember, when you're qualifying for a loan like this, you're going to be qualified on the higher interest rate and not the initial first year rate. But it does offer a level of comfort. I just had a deal where the sellers were able to get $430,000 for their home rather than $420,000, but then gave a $10,000 concession at close to help buy down the buyer's points on the loan, thus easing the buyer's interest rate for year 1 by 2 points and 1 point in the second year. After that, the rate's going to adjust up to where it would be normally at the predetermined percentage. And at that time, in 2 years from now, they could refinance. Maybe by that time, the interest rates will be lower. That's it. All I got to say on mortgages, buy downs, and seller concessions for today. I hope you enjoyed, got some value out of this content. And if you did, please press the like button or subscribe. Appreciate that. You help support this channel. Also, a big shout out to Mr. John Bostwick with Sierra Pacific Mortgage, Tabitha Diedrich with Movement Mortgage, and Ron Sika with Millennium Mortgage. These people helped me put this together. Also, there's a handy buy-down calculator that Ron Sika provided me that if you write me, I can send it to you too. Thanks again for watching. Live luxury now.